Hey, what's up guys? John here. The Fed declines to hike, but says rates are going to stay higher for longer. Interest rates are going to stay higher for longer.
No change. The Federal Reserve holding rates steady in the range, but leaving the door open for one more rate hike.
Now, many people are looking at this saying, well, it's a good thing. He paused. He took a pause. This means that they are seeing progress on this fight against inflation. But the reality is we couldn't be further from the truth. In fact, what's happening behind the scenes that the media is not talking about is what everyone should be paying close attention to. We are nowhere near a soft landing.
I've always thought that the soft landing was a plausible outcome, that there was a path really to a soft landing. I've thought that, and I've said that since we lifted off. It's also possible that the path is narrowed and it's widened apparently. Ultimately, this may be decided by factors that are outside our control at the end of the day.
I'm going to break down exactly what's going on here so you can see things very clearly to make smart, forward-thinking investing decisions. Please hit the like button. YouTube will share this content to educate other people. And if you want to fix your credit, you want to position yourself for the greatest wealth transfer of all time, which we're in right now, go to my company, greatcreditfast.com. That's greatcreditfast.com. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, any negative item on your credit report, do not let it sit there. One late payment can sit on your credit report for upwards of 7 years and bring your score down a whopping 180 points. So if you have one issue or a couple issues or however many issues you have in your report, don't ignore it. Take care of it today. Square away this issue so that when these incredible investing opportunities come, you can pounce on them. Go to greatcreditfast.com, schedule a free strategy session. Take a look at this. So this is very fascinating because at the same exact time, they put this here. They said that we are going to start to see the full effects of tightening have yet to be felt. Well, what that means is credit and lending is going to continue to contract. This economy is going to continue to contract because the last couple of years, the only reason in which we flourished like we did is because there were such loose lending standards. There was money everywhere. Everyone felt richer than ever before. And now that money is getting pulled off the street and it's getting taken away from the general public. And as that's happening, people are having a harder time getting loans, harder time getting financing. But that's only going to pick up more and more and more in about 10 days. 10 days, October 1st, what happens? Student loans. Student loans become due. Average payment, $504 a month. It's such a big number for 44 million Americans. 18% of the general public is going to start making these payments. So when you start to see this, you're going to start seeing a lot more defaults. At that same exact time, a $2 trillion corporate debt wall will spark job losses in 2024. This is from Goldman Sachs. They say that a looming corporate debt wall of more than $2 trillion is to shake the economy over the next 2 years. They noted that they're going to see about 5,000 job losses on average, 5,000 per month in 2024, and that's going to go to about 10,000 jobs per month by 2025. If interest rates remain high, like they just said they're going to remain higher for longer, then we are going to see a greater share of the revenue to cover interest rate expense as they refinance their debt at higher rates. Goldman Sachs said, we find that for each additional dollar of interest expense, firms lower their capital expenditures by 10 cents and labor costs by 20 cents, meaning they're going to start pushing more towards automation. They're going to start pushing more towards job outsourcing. They are going to start to try to make their companies lean and mean to make it through the tough times. Remember, last 3 years, it was a big push for the Great Resignation. The media was saying that everyone deserves more money because of inflation, and this is the responsibility of their employer. But as their employer now walks into a different type of economy with a different type of consumer that has less money, they're going to start to look for ways in which they're going to flip the script on this Great Resignation play that happened. They're going to start doing these outsourcing plays. They're going to start cutting jobs, moving into automation, robotics. They're going to start using different mechanisms in which they can save money. U.S. companies benefited immensely from the period of low interest rates before 2022. According to Bank of America, the debt composition of the S&P 500 companies include a whopping 76% in long-term fixed debt, much is secured at single-digit rates. Right? Well, that's happening, and now this situation with commercial real estate, it's getting harder than it's going to hit harder than the Great Financial Crisis. Here's how 5 other top institutions see it playing out. So when you start to look at this, you have consumers walking into student loans. You have employers walking into this $2 trillion corporate debt wall. You have commercial real estate investors and landlords walking into $1 trillion that needs to get refinanced over the next 12 months and $2.7 trillion over the next 3 years. Now I've shared this once before, David Sachs, he's in the All-In Pod, he's a multi-billionaire, and he owns a property in San Francisco, a $15 million asset with a $9 million loan on it, and he took it back to the bank because he was due to refinance his property at the end of the year. They said, we'd give you $2.4 million if you securitize it against other assets. So he ultimately just ended up paying the property off, but they were only willing to give a $2.4 million loan on a $15 million asset. Now imagine all the landlords that were buying these properties with 3% interest rates, 4% interest rates, with sky-high rents, with a completely different insurance market, lower property taxes. They're going to walk into a situation where they can't refinance. And so they're going to start giving keys back to the bank. And so when you have that situation unfolding, with the job market getting much tighter, you're going to start to see a scenario in which people aren't going to be able to afford to hold on to these 2, 3, 4% mortgages. In fact, I think many of these Wall Street investors know that. I saw this article, it was very interesting, from the Wall Street Journal. They said, a high borrowing cost and a shortage of properties for sale have slowed some home buyers from the Wall Street rental giants as well. I've been following financiers' home rental gambit for the Wall Street Journal since they dispatched buyers to the courthouse steps around the country to swoop up foreclosures in thousands during the Great Financial Crisis, 2008. When they ran out of foreclosures to buy, they turned them into rentals. They took to the open market to find more houses. Seldom have rental firms like AMH and Invitation Homes had such a small presence in the rental housing market as they do now. Financing has become expensive even for them, and competition is fierce for people willing to pay up for the new homes hitting new listings. Home prices have exceeded what big landlords can pay and still meet profit targets. So the big landlords, they're pulling back. Meanwhile, a lot of people say, hey, now's a great time to buy because you can refinance later. Well, if the smart money is holding back, there's a reason for it. They know that the job market's going to change, inflation's probably going to get worse, and the economy's going to get worse. Invitation Homes, which owns 83,000 homes, has been selling houses that have appreciated so much that returns renting them have dropped below what they can be earned owning treasuries. Executives say that they're putting the sale proceeds in the bank and earning more than 5% on cash, amassing money to buy pools of houses from what we'll expect will eventually be a lot of motivated sellers. Yep. AMH says it can get better returns building houses specifically to rent than it can buying them, and expects to finish more than 2,200 homes this year. The same dynamics that are making it hard to buy houses make it a great time to be renting them out. The economy is still reasonably healthy, so people, I don't see how the economy is reasonably healthy. How is the economy reasonably healthy? You've had 3 years of wage drops. 3 years. This report just came out last week. Wages have fallen for 3 years in a row. Inflation is at all-time highs. Consumer debt is at all-time highs. Average car payment is $730 a month, when in 2019 the average used car payment was $384. So you have double the car payment. Gas prices have literally doubled in the last couple of years. Inflation, many would say it's north of 20%, north of 15%, yet wages are softening. How is the economy still reasonably healthy? The economy has never been sicker. Wage growth is solid, but the barriers of homeownership are staggering. Managing real estate director of Green Street told me, even after surging through the pandemic, suburban rents are still a lot cheaper than financing a home of a comparable home in the booming markets where the big landlords operate. It's more than $1,000 cheaper to rent than it is to buy in many, right? The reality is rental rate increases, as aggressive as they've been, have not kept up with home price appreciation. Would you pay $1,000 more a month to buy a house today than to rent a similar property? What do you think about this? Do you think that we're walking into a situation where we are going to see this corporate debt situation unfold in 2024? Student loans are going to slowly be the final thing that's going to push people over the edge, where we're going to start to see more defaults on credit cards, auto loans, home equity lines of credit, home loans, personal loans. And as that happens, lenders are going to continue to tighten up, bracing for impact on the commercial real estate destruction that's likely ahead, as well as this corporate $2 trillion corporate wall of debt that has to get refinanced next year. I think we're walking into, and I've mentioned this before, the greatest wealth transfer of all time. The greatest wealth transfer of all time. We're walking into a situation where this upcoming recession/depression will be solved in large part by robotics and technology and automations and job outsourcing, when in the past, in the great financial crisis, in the dot-com bubble, in the stock market crash in the 80s, all of these other problems were caused by humans and solved by humans. This one is caused by humans, and it's going to be solved in large part by technology over the coming 5 years or so. This great wealth transfer, the next couple of years is going to be extremely important. Make sure you're making smart financial decisions and putting yourself in the best possible light to get financing. Make sure if you have credit card debt, existing credit card debt, at 25 or 28 or 30% interest, you're looking at 0% APR balance transfer credit cards. There's a variety of them out there. You're going to need a credit score of at least 730 in many cases to be able to get approved for a decent line of credit. So make sure you're positioning yourself, looking at your finances, and putting yourself in the best place possible to take advantage of some incredible real estate investing opportunities. Incredible opportunities just across the board are coming. So get ready for it. If you need help fixing your credit, we'd love to help you at my company, GreatCreditFast.com. That's GreatCreditFast.com. Again, if you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, any negative item on your credit report, do not let it sit there. It could sit there for 7 years. By that time, it's 2030. So if you had a situation last year, don't let it sit there. Don't let that situation hold you back from a bright future. Go to GreatCreditFast.com. I'll catch you in the next video.